Hello and welcome to Trading 5 Talents. In today's video, I want to go over a modification of the iron condor strategy that I've been working on. And really it's going to turn the condor into an iron butterfly or an iron fly. So let's get into it. So the iron butterfly or the iron fly is an iron condor, except the short options of that condor are the exact same strike. So otherwise everything is set up exactly the same. I am going to be referring to it as an iron fly because once you put that name butterfly in, it can get confusing because there's another form of an options setup that is just referred to as a butterfly or a long butterfly. And so I want to make sure that there's pretty good differentiation between those two. So I'm going to refer to it as an iron fly. The way that I'm setting up my iron fly is I am selecting the short strikes that are at the money. So the strike that is closest to where the current market price is, that's where my short strikes are going to be. And then my long strikes are going to be 10 strikes further out of the money than whatever those short strikes were. So that's the ATM, that's the at the money, it's 10 strikes, and then I'm going out 7 days until expiration, just like I was doing with the iron condors. So I am using the similar naming convention as I was before, just so we can keep everything consistent. And when I do this, you'll see that I'll be entering for approximately $600 in credit, or a $6 credit per iron fly. So that's much higher than obviously the iron condors were, which were about maybe $30 in credit versus, here $600 in credit. So I'm referring to this as the ATM 10-7 iron fly strategy. That way you can know just from the name exactly how this iron fly is set up. So let's take a look at the differences between an iron condor, an iron fly versus a long butterfly. So first of all, the iron condor is set up like this. On the bottom of that horizontal white line are the short strikes. So you can see on the left side, you have your short put credit spread, or your short put spread. Your short put vertical, however you want to call it, but your short put is closer to the money, your long put was further out of the money. On the right hand side, the short call is closer to the money and the long call is further out of the money. So with an iron fly or iron butterfly, you're simply taking your short strikes and making them the same strike price. So let's say your the strike price is, I don't know, $10. The short put would be a $10 strike price. The short call would also be a $10 strike price, and they're right at the money, at least in the setup that I'm doing. My long calls are staying the same. I'm just moving those short strikes together to make this iron fly. Now, how that differs from a butterfly or a long butterfly is like this. So you have the same setup in terms of where these strikes are in relation to one another as you do with the iron fly, except in this case, you're either using calls only or you're using puts only, which is why you can see it's shaded, in a gradient from green to red. So for example, if we were just using calls, you would buy a call on the left-hand side, sell 2 calls at the money, and then buy a call on the right-hand side. So you would be a long call butterfly, or if you did it with puts, it would be a long put butterfly. So you can see how all 3 of these are related to one another in terms of the option strike setup. But I was testing the iron condors in my first several iterations, and now I think I am liking the iron fly setup a little bit more, and I'll show you the reasons why as we continue. So I'm looking to get a profit of around $90 for every iron fly that I enter. I'm entering for about $6. And then I want to exit at around 15% of the credit that I received, or 15% of the max profit, which would be about $90 per iron fly. So I'd exit at $5.10, again, keeping that $90 in credit. Now it does require, at least the way this is set up, it does require $1,000 per iron fly in collateral, because since these are 10 wide spreads, that means it's going to be requiring $1,000 on either side. And that translates to about a 9% return on capital. So if I'm using $1,000 in collateral, getting $90, that would be about a 9%. Again, exiting at 15% of the max profit. And what I found through my early testing is I'm only in the trade for about 3 to 4 days, similar to what the iron condors were, that were 7 DTEs. It does increase the win rate because you're exiting much earlier. You don't have to wait until expiration. You're not waiting until 50% of the max profit is achieved. You just want a little bit of that total credit. And you're going to enter the next iron fly before the current one is expiring, because you can enter these every day on the SPY or on the Qs. So it does require more capital in that regard because you have to have these overlapping trades. Now, if I exit for a loss, this is when I'll be exiting. So when I lose 30% is when I would exit. So I'm either going to make 15% or I'm going to lose 30%. So the actual max loss of what I'm planning on taking is about $180 in loss per iron fly. So either gain $90 or lose $180. So why am I thinking that the iron flies are going to be superior to the iron condors? Well, again, this is all personal opinion. These aren't, trade recommendations. I just find that based on what I'm looking for in consistent income generating trades, this might seem like a better setup for me. And the advantages are, first of all, theta decay still works very well, just like with the iron condors, just like with the wheel strategy. Any premium selling strategy, theta decay is working in your favor, and it works once again here by entering these iron flies. You're only holding for a few days. You don't have to worry about holding till expiration. At least what I've found is that you don't have to hold until expiration. Therefore, you're going to mitigate that assignment risk, and you're going to have an increased win rate because you're exiting at that 15% max profit. Like I was doing with my previous versions of the iron condor strategy, I'm avoiding these binary events. I'm looking on the economic calendar. I'm exiting before those events happen, and I'm not entering an iron fly until after the events have happened, just to get rid of some of that volatility risk that I was seeing in the iron condor strategy. It's still a good risk to reward ratio for an option selling strategy. So risking 2 to make 1, I still think that's pretty good. And this is one advantage that I was very happy about with the iron fly, and something that I was concerned with the iron condors is the idea of scaling. So remember, with the iron condors, you're making just a small amount of money. So if you want to make more, you have to scale and sell more iron condors. But when you do that, you're going to have much higher risk. And so when you have these 10 wide iron butterflies or iron flies, it's already scaled. You're already making $90 instead of $9. And also, as we're going to see, the catastrophic loss will be much lower compared to an iron condor. And we'll take a look at that once I go through all the results in the next upcoming video. But those are these two that are bolded right here are the two main things that had me concerned with the iron condor strategies. And I think those have been solved, in this iron fly strategy. So what are the disadvantages? Well, it's going to be the same as the other strategies. It's going to require a lot more capital because you have overlapping iron fly positions, as well as require more capital because it's already scaled. You just need more. All right, so let's take a look now on Robinhood on how to set one of these iron flies up. Okay, so here we are in Robinhood, and we're taking a look at the ETF SPY or SPY, which tracks the S&P 500. You can see the closing price for this past week was $411.65. So it is the weekend, so the markets are closed. And the way that we would set up this iron fly is we'd go to trade and then trade options. What we want to do is look for a 7 DTE expiration in this example. And so that's going to be February 13th based on, the market's going to be opening February 6th on Monday. So February 13th. And the first step that I do is I go to sell. And so here I'm selling a call, and the current price of SPY is $411.65. So let's just round that up to $412. That's the closest strike to the current market price. So that's the at the money strike. So I'm going to sell a call, then I'll go over to buy, and I'm going to buy 10 strikes further out of the money. That would be the 422. All right. Now I'm going to sell a put, again, 412. And then I'm going to buy a put 10 strikes further out of the money. That would be 402. Like that. So when I click down here or tap down here on this bottom part, you can see it recognizes or doesn't recognize it as an iron fly or an iron butterfly. It just simply calls it a 4-option order. But you can see our calls are up here, our puts are down here, and in this instance, we are collecting a $6.18 credit. So $618, and then our max loss is 1,000 minus that credit, which is $382. So if we tap on review, you can see the review of that order right here. Now, what I typically do is I go on the lower end. So I go on the bid price. So if I want to sell one of these, what I'm going to do is I'm going to just, type in one, go down here to the bid or to the limit price, and then I enter just above the bid price. So maybe it will be $6.20. That's just so I can get a quicker order fill. It's completely up to you if however you want to do it. If you just want to default to the mid price, which is the average between the bid and the ask, that's what it's defaulting to right now. But I like to get a quicker fill order, and so that's why I go down to the bid price or just above the bid price. All right, so let me cancel out of this and let's take a look at what we're doing here. So on the call side, 422 buy, 412 sell. That's a call credit spread, and you can see those numbers there. And then on the bottom, we have the put credit spread, the 412 and the 402. So let's take a look at Option Strat to see how this would play out. Okay, Option Strat is a website that allows you to build an option strategy, and you can take a look at the profit and loss over time. You can also save some of your strategies here if you have a free account. Right now, I'm just using a free account. There is an affiliate link down below if you want to use it, if you want to become a member and get access to some of the more premium features. But I'm just using a free account for this video. So what we're going to do is we're going to start here on the homepage, go to build, and it's called an iron butterfly right here. And so you can see the description at the bottom. An iron butterfly has similar characteristics to a put or call butterfly, but is established as a net credit. It's made of a combination of a bull put spread or a bear call spread. Volatility should be low to run the strategy, as increasing volatility will narrow the profitable range. Time is helpful when the position is profitable and harmful when it isn't, also known as a short iron butterfly. So let's take a look at this setup here. So we'll click on the iron butterfly. All right, so here we are with the iron butterfly. This is the default setup. So what we'd like to do is make sure that we are using SPY right here. The expiration is what we were looking at before, which was February 13th. And we were choosing the 412s as our short strike. And so that means our long put strike would be 402 and our long call strike would be 422. These are just 10 strikes wide from that center position. And so we were entering in our example, I think it was like $6.18. So let me just enter those numbers here. The 402, so this would be the long put. In Robinhood, this was $1, and then our short put would be $3.77, and then our short call was $4.27, and then our long call was 86 cents. 86 cents. All right, so you can see $118 would be our net credit, and then our max loss would be $382. Again, where they get this from is the collateral, which is $1,000, which is the width of one side of these, the iron fly, $1,000 minus our credit. So that'd be $382. So this is what it looks like if we zoom out. Zoom out here. This is what the profit and loss graph looks like for an iron butterfly or an iron fly. So there's a lot of profit that can be made if the price stays exactly where it is by expiration. That's the max profit. So if we were to do something like this, where we go 3 strikes wide for an iron condor, this is your typical, iron condor profit and loss that you're familiar with. But what we're doing is we're actually just narrowing that profit range more or less so that they're exactly the same right here. But it peaks right at the money. And we're not, at least I'm not, looking to gain all of the credit right here. What I'm looking to do is simply gain a portion of that credit. So again, let me just put these prices back to where they were for our example. So I'm only looking to gain about $90. So right about here to right about here. Okay, so my profit range is still, quite wide if we were to let this go until expiration. But again, we're only in it for about 3 to 4 days. I only want to get 15% from this. So if we look at the table, you can see around $90. If it stays in that range right here, we're going to get that. So this would be Monday, Tuesday. So we're going to get that about Wednesday. That's probably when we'd be able to exit this. It doesn't expire until the following Friday, but we'd be able, the following Monday, 2 Mondays from now. So we'd probably be able to get out by Wednesday, hopefully, maybe Thursday at the latest, but we definitely wouldn't have to hold it until expiration. Again, I'm going to exit at 30% of the credit. So I'm either going to gain, again, $90 or lose about $180. I don't know when that would occur, but obviously the profit range is going to be a little bit narrower than the iron condor, which is fine in my case because I'm able to exit the trade earlier than I could with the iron condors as well. So that's why I think it would be an increased win rate if I set it up like this. So I'm only looking for 15% of the profit with the iron fly, whereas before I was looking for 50% of the profit with the iron condor. Therefore, I had to stay in the trade longer, thereby increasing my chance of loss. So by the time that I post the results video, I would have gone through 30 trades. And so that's a lot, more than, the 10 trades that I was going through with the iron condors. And again, it's still a small back test, but I still think it's going to give a pretty good indication of where we can improve on this strategy, or if the strategy just isn't viable at all. But in the next and upcoming video, I'm going to have 30 trades of the iron fly using this setup, and we'll see how profitable that strategy is going to be. So please click on the subscribe button and turn on the notifications so you can catch when that update is. Until next time, trade wisely and take care.